The 30-year mortgage is the most common financial tool. I mean, the order of life seems to be go to school, get a degree, find love, buy a house, and do so with a 30-year mortgage. But I bet you, the person watching this video right now, probably have very little, if not any idea how much money you're losing just by having a 30-year mortgage. Now, the reason why I say this is because for those that may not know, my name is Daniel Kwok, one half of the Kwok Brothers, and my brother Sam and I happen to own a company called Accelerated Strategies, where for many years now we've helped thousands of families across the country pay off their mortgage in a fraction of the time without having to change their lifestyle. In fact, we often find with our clients that what people think is the smart thing to do when trying to pay off their debt faster actually ends up hurting them and costing them way more than they realize. So in this video, I'm gonna lay out the 3 most common ways you, the average American, lose money on a 30-year mortgage without even knowing about it. Starting with number 1, which is the hidden cost of refinancing. Now, most homeowners think refinancing is automatically a smart move because they're lowering their interest rate. But here's the part that no one realizes. Every time you refinance, you reset the amortization schedule back to day 1. And what happens at the beginning of a 30-year mortgage? Well, almost all your payments goes towards interest and not principal. In fact, let's say you buy a $500,000 home at 6% and you put down 9%, which is what the average first-time homebuyer put down in 2025. And with those numbers, your monthly payment ends up being a little over $2,700. However, in your first monthly payment, $2,275 of that goes to interest, and only $452.95 is what's bringing down your actual loan balance. So even if you refinanced into a better rate, which a lot of people did in 2021 and 2022, when interest rates were lower than 3%, what you really did was voluntarily restart the clock on paying mostly interest for the next several years. And that's why some people will refinance 2 or 3 times throughout the lifeline of their loan and then wonder why their balance barely moved even after a decade of faithfully making monthly payments. And on top of that, refinances aren't free. You've got lender fees, appraisal fees, title fees, and who knows what other fees your banks might charge you. And that's thousands of dollars rolled back into the loan, which is what the banks want, because guess what? That's how they make their money. So yes, you might get a slightly lower rate, which still might be a great overall financial decision, but you still extended how long the bank gets to charge you interest. And in many cases, you end up paying more over time and not less. And that's why banks love sending out pieces of mail to your house, selling you on a refinance, because it looks like they're helping you save on monthly payments, but in reality, what they really want is securing another 30 years of guaranteed income for themselves. Imagine running a marathon, running all the way to mile 20, and then being told that, hey, you should restart the marathon because we're gonna give you some nicer shoes. Now, this is what brings us to the second way that most Americans lose money on their mortgage, which is they believe the myth about just make an extra payment. Now, I'm not saying extra payments are bad, but they're not as nearly as effective as people think. And here's why. The mortgage system is designed so that your interest is calculated based on your current balance and the time it stays there. So even if you make one extra payment at the end of the year or even month, you're taking away that cash that could be used for different things, or in this case for Americans, the cash that they may not have or be able to afford, and you're bringing down your balance by this much. And really, the interest that the banks charge you really doesn't make that much of a difference compared to the value of that cash that you have today that you're putting into that mortgage. In fact, here's what we tell our clients that I'll say for free here on YouTube. It's not about how much extra you pay, it's about how early you lower the balance. Because at the end of the day, the amortized interest on the mortgage is calculated based on the existing current balance, and we may have found that it would have been better if we just took the extra payment and invested it. In fact, it's really not worth paying down the balance unless you can bring it down in bigger chunks early, which is what we actually help our clients do every single day. On top of that, most people can't afford to make extra consistent payments anyways, because let's be real, life happens, whether it's kids, emergencies, or just unexpected expenses. So oftentimes what we find, the just make an extra payment strategy ends up being inconsistent, unpredictable, and not nearly as powerful as people think, which is what brings us to the third and final point of this video, which is not using a line of credit even if the interest looks higher to pay down your mortgage faster. Now, this is the one that surprises most people. We see it every single day, but it's also the biggest opportunity most homeowners miss in the form of an opportunity cost. Now, maybe some of you guys will ask, well, Daniel, why would I use a line of credit to attack my mortgage if the line of credit has a higher interest rate? Like, why would I use a 9% line of credit to pay off my 3 or 4% mortgage? Well, that's because mortgage interest and line of credit interest are completely different. You're talking about amortized interest versus simple interest. In fact, to illustrate, let me ask you a question. Would you consider 30 degrees to be cold? And well, the answer is, it depends. Because if you ask the average American, they'll tell you, yes, 30 degrees is absolutely freezing. However, if you ask my parents who live in Seoul, South Korea, they'll tell you that 30 degrees is amazing. Now, obviously that's because here in the United States, we track temperature in Fahrenheit, while in South Korea, they track temperature in Celsius, meaning 30 degrees Celsius is way hotter than 60 degrees Fahrenheit, even though 60 is a bigger number. Just like how a traditional 30-year mortgage will charge interest amortized based on a fixed balance over a 30-year time frame, and also the interest is front-loaded, which means you pay the bank first and yourself last. However, a line of credit charges interest based on the average daily balance, which means if you lower the balance faster up front, your interest costs collapse with it, which is why we have what's called the total interest percentage, which is the percentage of what interest you actually paid at the lifeline of the loan. Meaning that if you have a $500,000 loan and you end up paying $500,000 in interest by the end of the loan, which is the case for most people, your total interest percentage, or the tip, is actually 100%. So even with the higher rate on a home equity line of credit, or any line of credit for that matter, if you're able to push your income through the line, drop the balance aggressively, and chunk your mortgage in larger pieces sooner, like we talked about in the previous point, then you actually end up saving far more than someone making small occasional extra payments. So it's about not working harder, it's about working smarter based on how the banks structure amortization. So all in all, it's not about the interest rate, it's about the interest structure. And this is why so many people lose tens of thousands, sometimes hundreds of thousands of dollars without knowing it, because, well, they stick to the traditional system the bank taught them instead of using the tools that work in your terms instead of theirs. Now, if you want to get deeper on how you can pay off your mortgage faster and even as early as 5 to 7 years without having to make more money, or maybe you're just super skeptical at this point and you want more info to prove us wrong, my brother Sam does a free virtual training, and I'll make sure to post the link in the description below so that you can go ahead and watch it. Again, it's virtual, it's free, no cost to you guys. And of course, if you like this information, please like, subscribe, and comment, because it really does help push this information to as many people as we possibly can, which is the goal. So thanks for watching, and I'll see you guys in the next one.